All right, so buckle up, everybody, because today we're diving headfirst into BlackRock's latest earnings report and supplement. We're talking Q4 and the whole of 2024, and let me tell you, it's a wild ride.
Definitely a lot to unpack.
We're talking record inflows, surprising acquisitions, and maybe even some hints about where the future of finance is headed.
Sounds exciting. Let's get into it.
Okay, so first things first. BlackRock hit a mind-blowing $11.6 trillion in assets under management, or AUM, by the end of 2024.
Wow, that's more money than, well, it's hard to even imagine that much money.
It really is. And to make it even crazier, they pulled in a record $641 billion in net inflows for 2024.
With a staggering 281 billion of that coming in just Q4.
It's like they added an entire Fortune 500 company to their portfolio every few months.
It's remarkable.
So what's driving this incredible growth? Is it just the market doing its thing, or is there something more strategic going on here?
Well, the market definitely plays a role, but BlackRock's success isn't just about riding a wave. Their revenue is up 14% for the year, and that's going to be driven by a bunch of different things.
Right, like what?
Well, they're seeing strong organic base fee growth, which means people are actively choosing to invest with BlackRock, and they're growing those relationships.
Okay, so it's not just luck, it's real interest.
Mm-hmm.
But they've also been on a bit of an acquisition spree, right?
Yeah.
Snapping up companies like GIP, HPS, and Preqin.
Exactly. And I think those acquisitions really point to a broader trend in the asset management industry.
Like what? Fill us in.
Well, BlackRock is super focused on expanding into private markets.
Uh-huh.
And on top of that, they're also really bolstering their data and technology capabilities.
Okay, so GIP is all about those infrastructure investments. HPS broadens their private credit offerings, and then there's Preqin, which brings in powerful data and analytics.
Exactly. It's like they're building a financial powerhouse for the future.
So it sounds like they're not just trying to get bigger, they're trying to position themselves for what finance will look like in the years to come.
I think that's a very smart way to put it.
But with all these acquisitions and changes, how is this all affecting BlackRock's bottom line? Are these moves actually paying off?
Well, despite the cost of all these acquisitions, BlackRock still boasts an incredibly impressive 44.5% operating margin.
Wow, that's pretty amazing, especially when you think about how much they're investing in technology at the same time.
Yeah, they're pouring a ton of resources into their Aladdin platform. It's clearly a big part of their strategy.
And they've even been restructuring parts of the company to really focus on Aladdin and their private market strategy.
Right. That restructuring charge from Q4 2023 that you mentioned shows just how committed they are to these areas. They're betting big on technology and private markets as the drivers for future growth.
And it seems like it's working, right?
Yeah.
I mean, their technology services revenue is up significantly, and Aladdin's a big part of that.
Absolutely. Aladdin is a game changer.
Okay, but for those of us who maybe aren't finance experts, could you explain what Aladdin is exactly and why it's such a big deal?
Sure. Think of Aladdin like a supercomputer for finance. It's this super sophisticated platform that tons of institutional investors all over the world use to analyze risk. It's how they manage their portfolios and make those big investment decisions.
Yeah.
And it's become such a core part of what BlackRock offers, especially for their larger clients. It's a huge competitive edge for them.
So it's not just about how much money BlackRock manages, it's about the technology and expertise that they're bringing to the table.
Exactly.
But we've been talking a lot about these big institutions and high-level strategies. What about the individual investor, someone like you or me who's just trying to save for retirement or their kids' college? How does BlackRock's strategy affect us?
That's a great question, and it's something we should definitely explore more as we dig deeper into these numbers. One thing to think about is that as BlackRock expands into those private markets, it could potentially open up new investment opportunities for everyday investors, things that were previously only available to those big institutions.
So potentially some new exciting options for us to explore.
Exactly.
Well, that sounds pretty intriguing, but I'm sure there are potential downsides too.
Definitely. We'll need to unpack those as well.
Okay, so let's shift gears a bit and look closer at those record-breaking net inflows. $281 billion in a single quarter. That's just an insane number. But I'm really curious, where is all that money coming from? And what does it tell us about how investors are feeling right now?
Yeah, let's break down those flows and see what insights we can gather.
One thing that jumps out from the report is that long-term net flows for Q4 2024 were $201 billion. That's still a massive number, but it's quite a bit lower than the $489 billion they pulled in Q4 2023. Should we be worried about that?
That's definitely something to pay attention to, but I don't think it's necessarily a reason to panic. 2023 was a bit of an outlier, you know. Those numbers were so high because of some specific market conditions that just didn't repeat in 2024.
Okay, that makes sense.
We really need to look closer at the flow breakdown to understand what's happening.
So let's do that. What does the breakdown by client type and investment style tell us?
Well, institutional active flows were really strong at 53 billion, which is a good sign.
Meaning?
Meaning those large institutions like pension funds and endowments, they're still actively choosing BlackRock to manage their money.
Makes sense.
But as you might expect, ETFs are still a huge driver of inflows, pulling in 143 billion during the quarter.
Not surprising at all, ETFs are super popular these days. People are always looking for those low-cost, diversified investment options, and BlackRock's iShares ETFs are definitely a leader there.
Right, exactly. And it's worth noting that both BlackRock's actively managed funds and their index funds have been performing well over the past 1, 3, and 5 years. This consistency across different investment styles, that's another big factor in their success.
So they're not just riding that wave of passive investing, they're also delivering strong returns for their active investors.
Okay, I think we've got a good grasp on the growth story here and that flow breakdown. But now let's dig a little deeper into BlackRock's revenue and expenses. What are the key takeaways there?
Well, I'd say one of the most important things to notice is that BlackRock's revenue isn't just coming from base fees anymore. They're seeing significant growth in performance fees and in their technology services revenue too. It paints a picture of a more diverse, resilient business model.
It's good to hear that they're not putting all their eggs in one basket, so to speak. But I imagine higher revenue usually comes with higher expenses as well, right? So what's driving their expenses up?
You got it. Employee compensation and benefits are the biggest chunk of their expenses, and that's no surprise. I mean, you got to invest in your people, especially when they're bringing in those record profits.
Right, exactly. And remember all those performance-based incentives we talked about? Well, you're seeing those reflected in this line item. They're rewarding their employees for the company's success.
Makes sense. Anything else stand out on the expense side?
Well, there's that restructuring charge we mentioned earlier, but that's a one-time thing related to their strategic reorganization. Other than that, their expenses seem pretty well managed.
All right, so we've covered a lot of ground here. We've seen how BlackRock is growing at an incredible pace, and it's fueled by a combination of market performance, strategic acquisitions, and this strong focus on technology. But there's still one piece of the puzzle we need to explore in more detail, and that's their push into alternative investments.
Yes, definitely. BlackRock is making some bold moves in the alternative space, and it's definitely something to keep an eye on.
Let's dive into that next.
BlackRock's alternatives business, it's definitely gaining traction. You can see it in the numbers. There's a clear increase in both client assets and fee-paying AUM in this area.
And when we dig into the details, what are we seeing? What types of alternative investments are really driving this growth?
Well, private credit's definitely one to watch. And then there's infrastructure. Oh, and liquid alternative assets. Those are showing a lot of growth, too.
Okay, so it's not like they're just dipping their toes in the water here. They're making a serious commitment to alternatives. What do you think's driving this push? Is it just about chasing higher returns, or is there something more strategic going on?
It's probably a mix of both, right? Like, we've been in this low yield environment for a while now, and it's pushed investors to look for other options.
Yeah, I got to find those returns somewhere.
Exactly. And BlackRock, they're just responding to that demand. Both institutional investors and individuals, they're all hungry for alternatives that can potentially offer higher returns.
That makes sense. But I got to believe there's more to it than that. I mean, BlackRock isn't known for making impulsive decisions. They've got to be thinking long term.
Oh, absolutely. They're not just chasing the latest fad. BlackRock's thinking about the bigger picture, the long-term trends that are shaping the investment landscape.
And what are they seeing?
Well, they see a growing need for diversification, for one thing.
Uh-huh.
And they're betting that alternative investments, those are going to play a key role in helping investors build those more resilient portfolios.
So it's not just about making more money. It's about protecting what you've already got and navigating a financial world that's, well, let's face it, it's getting pretty unpredictable.
Exactly. And on top of that, BlackRock's move into alternatives, it's really tied into their focus on technology and data, too.
Right, they're all about Aladdin. So how are they using all that tech in the alternative space?
Well, they're using their tech prowess to create these really innovative investment products and platforms that actually make it easier for investors to access and manage alternative investments.
So they're trying to make alternatives more user-friendly, less intimidating for the average investor.
That's a great way to put it. They're trying to break down some of those barriers to entry.
So instead of alternatives being this exclusive club for the super rich, BlackRock's trying to open it up a little bit.
It's definitely a possibility, and it's something to watch as they continue building out their alternatives platform.
That's a fascinating thought. Okay, but let's play devil's advocate for a second. Every rose has its thorns, right? What are some of the potential downsides to this big push into alternatives?
Sure, we got to be realistic.
Mm,
One thing to remember is that alternative investments, they can be a lot more complex than traditional stocks and bonds.
yeah, they're not exactly for beginners.
Right, and they can be less liquid too. Harder to get your money out quickly if you need it. And often they come with higher fees.
So it's not something to jump into lightly.
Definitely not. You got to do your homework, understand the risks involved, make sure any alternative investment fits into your overall financial plan and risk tolerance.
Don't put all your eggs in one basket, as they say.
Exactly. Now, here's another thing to think about, and I hesitate to even bring this up because it sounds a little, well, conspiracy theory-ish. But with BlackRock getting so big and so powerful, does that create any risks in itself? I mean, they're already managing trillions of dollars. If they dominate alternatives too, could that be a problem?
It's a valid question, for sure. Anytime you have a single entity controlling a huge chunk of the market, there's potential for, well, for things to go wrong.
Right, concentration risk is a real thing.
Mm.
We need healthy competition in the market, a diversity of players to keep things stable and make sure no one gets too much power.
Checks and balances, right? It applies to finance, too.
Absolutely. It's something for all investors to be aware of, whether they're considering BlackRock or any other large asset manager.
So yes, there are risks to consider, but overall, it sounds like BlackRock's move into alternatives, it's driven by a combination of things. Market demand, some smart long-term planning, and a really impressive use of technology. It's definitely creating some interesting new opportunities, but as with any investment, it's all about understanding the risks involved.
Couldn't have said it better myself. Now let's take a step back and look at the earnings report and supplement again. Anything else in those documents that really stood out to you?
Yes, actually, I was really intrigued by the breakdown of BlackRock's AUM by client type, style, product type, and region. It really paints a picture of their global reach, and just how diverse their client base is.
Yeah, it's impressive. So starting with client type, institutional clients, they still make up the lion's share of their AUM at 54% of the total.
So those big institutions are still their bread and butter?
They are, but don't underestimate their retail business. It represents a solid 25% of their AUM, which means they're not just focused on the whales, they're also serving those everyday investors like you and me.
That's good to know. Now, what about the breakdown by investment style? What are we seeing there?
Well, unsurprisingly, index funds and ETFs, they're the heavy hitters.
Yeah, those are all the rage right now.
Exactly. They make up 67% of long-term AUM, which lines up perfectly with the broader trend towards passive investing.
Makes sense. And then by product type.
Equity products are in the lead at 55% of long-term AUM, followed by fixed income at 25%. Multi-asset and alternative products are still relatively small slices of the pie, but as we've been discussing, BlackRock's definitely making moves to change that.
Right. Alternatives are their big growth area right now. And geographically, are they still mostly focused on the U.S.?
The Americas are definitely their biggest market, representing about 68% of their AUM. But they've also got a strong presence in EMEA and Asia Pacific, so they're pretty well diversified geographically.
So a true global player, which, given their size and ambitions, isn't really a surprise. Now, turning back to their financials for a moment, the supplement gives us a pretty good look under the hood in terms of their revenue and expense trends. Anything in particular that caught your eye there?
You know, what really stood out to me was that consistent upward trend in base fees, performance fees, and technology services revenue over the last several quarters. It just shows you they've got this solid, diversified business model, and they're not overly reliant on any one thing, like just market performance.
Those charts and graphs in the supplement do a really good job of bringing that to life. It's pretty impressive to see how their revenue streams are evolving and becoming more diverse.
Absolutely. And on the expense side, the biggest factor is definitely employee compensation and benefits, which isn't surprising considering how much they're investing in talent. Then you've got your sales, asset, and account expenses.
It makes total sense. They're clearly prioritizing attracting and retaining the best people, especially with those performance-based incentives. They're putting their money where their mouth is when it comes to investing in their human capital.
Exactly. They understand that Their people are their most valuable asset. And those employee compensation expenses, well, a good chunk of that is driven by those performance-based incentives.
So it's not just about throwing money around, they're rewarding their employees for actually delivering results.
Okay.
It's a good sign when a company is willing to tie compensation directly to performance.
Agreed. Now, before we start wrapping things up, there's one more detail from the supplement that I wanted to highlight. They talk a lot about their commitment to sustainability and how they're integrating ESG factors into their investment process.
That's huge these days, right?
Yep.
More and more investors are looking to put their money where their values are. So what are some of the key takeaways from the supplement on BlackRock's ESG efforts?
They emphasize their commitment to engaging with companies on ESG issues, coming up with sustainable investment solutions, and advocating for policies that support a transition to a low-carbon economy. It's clear that sustainability is more than just a buzzword for them. It's becoming a core part of how they do business.
It's interesting to see how they're positioning themselves, not just as a financial powerhouse, but as a leader in the ESG space. This could really appeal to those investors who are looking to make a positive impact with their investments.
Absolutely. And it reflects a bigger trend in the industry as a whole. Sustainability isn't just a niche concern anymore. It's becoming a mainstream expectation.
Okay, so we've covered a ton of ground here. We've seen BlackRock's record-breaking growth, their strategic moves, their technological savvy, their push into alternatives, and even their commitment to ESG. It's clear they're a company that's constantly evolving and adapting to the ever-changing landscape of the financial world.
They're definitely a force to be reckoned with. And before we wrap up completely, I want to leave you with one final thought-provoking question. Given BlackRock's size, their influence, and all these trends they're driving, how do you see the relationship between individual investors and these massive asset managers evolving in the future?
That's a great question. Will it be more collaborative, or will there be a growing sense of distrust? It's something we should all be thinking about as we navigate this increasingly complex financial world.
It's a conversation that needs to happen, and it's a reminder that as individual investors, we need to stay informed, ask the tough questions, and make sure our voices are heard.
Excellent advice. So to sum up this deep dive, what are the key takeaways our listeners should walk away with?
All right, let's break it down. First off, BlackRock is a true financial powerhouse. They have a huge amount of influence, and they're not just managing money, they're shaping the future of finance.
Yeah, and they're not afraid to embrace new technology, expand into new markets, and really adapt to what investors need. It's pretty impressive.
Absolutely, and their focus on technology, especially with Aladdin, that really sets them apart in this industry. Aladdin's given them a real edge, and it's allowed them to offer these innovative products and services to their clients that others just can't match.
It's like they've built this financial superhighway, and Aladdin's the GPS that's guiding everyone along.
That's a great analogy. And another key takeaway is their move into alternative investments. That's a big deal, and it has the potential to really change the game for everyone, not just big institutions.
Yeah, it could open up a whole world of opportunities for individual investors, but it's important to remember that there are risks involved too.
Definitely. You have to do your research and make sure any investment aligns with your own personal goals and risk tolerance.
Don't just follow the crowd, right? Think for yourself.
Exactly. Now, here's something else to think about, and it's kind of a big question. BlackRock's size and influence raise some interesting questions about the future of the asset management industry.
Like what?
Well, could we be headed towards a scenario where just a few giant firms like BlackRock control the majority of the market? And if so, what does that mean for competition, innovation, and, for the individual investor?
That's a great point. It's definitely something to keep an eye on.
Absolutely. So as we wrap up this deep dive, I want to leave everyone with this idea of informed curiosity. BlackRock's story is just a small part of this much larger story about the forces that are shaping the world of finance. It's constantly changing, and it's more important than ever to stay engaged, stay informed, and most importantly, stay curious.
Well said. The more you understand about what's happening in the markets, the better decisions you can make for your own financial future.
Exactly.
And that's a wrap on our deep dive into BlackRock's latest earnings. We hope you learned something new, and we'll be back soon with another deep dive into the fascinating world of finance. Until then, happy investing, everyone.